Welcome back. You're still watching Trading Hour. It is looking good for the markets like we've been pointing out, and a lot of earnings reactions also coming through, and that's what's really sort of dominating. So a few disappointments, of course, the likes of Axis are under pressure, but the rest of the market seems to be holding up. Let's get a conversation going. Dhananjay Sinha, MD and Head Strategist at JM Financial Institutional Services, joins us now. Dhananjay, good morning. Thanks a lot for joining us today. This is Pavitra. Right now, I think the next big point that the markets are watching closely is the Fed meet next week. So in that context, also, of course, there have already been indications that there could be a 50 basis points hike in May. In that context, how are you looking at the global setup, and how much of this do you think is already priced in?
So I think people are still sort of looking at what kind of magnitude of rate hikes will happen. So I think people are coming up with various numbers. You have U.S. inflation at 8.5%. That's almost like 4 times higher than what Fed normally targets. So essentially, people are looking at much higher and cheaper rate hikes going forward. And I think numbers are floating around 4%, 5%, or even 6%. So that's a fairly steep rise as people are expecting. And I think more importantly is what would happen to the balance sheet size. And I think the reduction in the balance sheet or shrinkage in the balance sheet is something that would be relevant from a market standpoint, because right from the pandemic bottom, I think there has been a significant role of this balance sheet expansion. It's doubled, by the Fed. And I think the numbers that are floating around is about $100 billion per month. So it's quite possible that the liquidity that permeated across global markets would actually come off. So I think that's where the market is actually looking at, and I think that's got a spillover effect on Indian markets as well. If you look at FII flows has been a negative of $17 billion last year, and it continues to be negative. So what needs to be seen, the relevance of that with respect to the dollar view. The dollar is hardened to almost like a 20-year high, and RBI is managing its currency by running down its reserve, but it's been managing. So I think it has got an implication for multiples in India. There has been certain volatility that has arisen in the recent times. If you look at last 3-4 months, I mean, it is swaying between a risk on, risk off thing. But my sense is that as that sort of liquidity tightens, the guess is that the multiples should actually be normalizing going forward. So I think the relevance of global liquidity on Indian market multiples will be very important, especially in the context where the margin pressures are there, and there is a possibility of earnings expectations being tempered going forward. So I think these are the contexts that other markets will have to grapple with going forward.
Okay. That's on the market. Dhananjay, I wanted your thoughts on something like an Axis Bank that has been under pressure post its numbers, I guess because the management themselves said that operational expenses will remain high and the margins will take time to recover. But your thoughts, are these great buying opportunities in quality names like Axis?
So the way to really look at banks is to, the market would actually look for growth and margin expansion because a lot of the NPA cycle has already been priced in. So, what we are basically looking forward towards is a rising rate scenario. And typically in a rising rate scenario, the general expectation is that the margin for the lending business increases because the lending rates go up higher, faster than the deposit rate or cost of deposits or cost of fund. Hence the margin expands. But my sense is that this cycle is different. Because post the pandemic, banks had reduced the term deposit rates and made it equivalent to the saving deposit rates, and they had a benefit of switch from a term deposit to CASA deposits, and that benefit added to the margin. So with the falling rates, you had a margin expansion. So going forward, I would say that as the rates are rising, then the normalization of deposit costs will be faster than the term deposit or the lending rate. As a result of that, we are seeing pressure on margins. And, in the banking system, we are also seeing people investing in technology, the investments into people, etc. So that part is also rising. So essentially, we have to really look at banks that can actually grow market share. I mean, Axis Bank and HDFC Bank and ICICI Bank are growing faster than the system. So basically they are increasing market share, but yet we are seeing that some banks have actually seen margins declining. HDFC saw the margins decreasing to some extent. Axis Bank also saw it, whereas ICICI Bank saw a margin expansion. So essentially, what is happening is that I would say ICICI Bank, which has actually taken larger credit risk by gaining exposure in credit cards, business banking, and also SME lending. So they are trying to increase margins, etc., by taking on more market risk. So I think our credit risk. So I think the market would actually be favoring banks that can actually show margin expansion, profit growth, have a certain amount of buffer with respect to capital, and of course a lot of profit is coming from reduction, provisioning, etc. But I would say largely, the market would look at or prefer banks that can expand profitability, margins, etc., with a prudent balance sheet context. So I think if you look at the pecking order, so we have in our portfolio, ICICI Bank is the largest weight, and followed by HDFC and Axis, but that's what it is. But we are sort of underweight on the banking and financial services space because we think that the global context in terms of valuation, etc., are far more relevant for the lending business, especially in BFC and banks. So I think we are somewhat underweight on BFSI.
All right, Dhananjay, I think we got a very short duration, but it's a Friday, so let's talk about some of those unlocked trades. Some of them have been up and away. Whether you look at the Indian hotel stocks, some of those aviation stocks, travel stocks. Would you play this theme, or is the best behind us? Maybe 15 days or so ago, you would say Indian hotels, well, it's had close to around 30% rally. It's done and dusted. It's up close to 40% for this year itself. Do you believe some of these stocks have more theme, or will you avoid it? Go ahead.
Yeah, I think it's a fantastic space to be in. I would say that relatively, the opening up sectors, services sector had been a laggard. So we are seeing good traction as far as business is concerned. I think, and I would say multiplexes, etc. I mean, the urban sector is actually sort of improving, and I think there is an operating leverage that is happening out there. So I would say that, valuations apart, I think, these businesses should actually attract sort of investor interest because they are coming up from a very adverse sort of operating matrix. So it's possible that for the entire, pack, there can be an increase in sort of, I would say, operating stuff such as margins, etc. So I think that operating leverage will actually play out here.
All right, we leave it at that, Dhananjay. Thanks a lot for joining us and giving us a view on the markets. By the way, that's the new concept.